Bapak Reza Yamura Sirgar is the head and senior executive vice president at IFG Progress. His research interest covers open and development macroeconomics, monetary economics, international finance and trade, and applied time series econometrics. Bapak Reza has held many notable positions in the past, including as the chief representative of the Singapore office of the Institute of International Finance, executive director and chief ASEAN economist at Goldman Sachs, Singapore, senior economist at the International Monetary Fund, and lead economist at the ASEAN+3 Macroeconomic Research Office in Singapore. Currently, Bapak Reza is also serving several capacities, notably being a special advisor to the Coordinating Minister of Economic Affairs of the Republic of Indonesia, a faculty member at the BI Institute, adjunct faculty of the Asian Public Policy Program at Hitso Subhashi University, as well as a financial sector advisor at Prospera. Next speaker who will be joining us from via video conference from the US would be Bapak Gita Wiryawan. Bapak Gita Wiryawan is an educator, an entrepreneur, and an artist. He was the Ministry of Trade of the Republic of Indonesia in 2011-2014, as well as the chairman of the Investment Coordinating Board in 2009 to 2012. He had a long career in banking, having served at Goldman Sachs, JP Morgan, and Citibank. He was also commissioner at Pertamina and independent commissioner at Axiata Group Berhad, as well as Axiata Excel. Third, also joining us via video conference, we have with us Dr. Ranjit Singh. Mr. Ranjit Singh is Assistant Director, Monetary and Capital Markets and Chief Global Markets Analysis at the International Monetary Fund. Mr. Ranjit has primary responsibility for monitoring global financial markets and assessing risks to financial stability, including the IMF's flagship Global Financial Stability Report. He also advises on financial market regulation, non-bank financial intermediation, climate risk, and sustainable finance. He's an experienced international policymaker with 25 years experience in market development, regulation, and policy. Fourth, we call onto the stage Mr. Prakash Kannan. Mr. Prakash Kannan is a managing director, chief economist, and head of total portfolio management at GIC. He is responsible for medium-term global macro and asset allocation strategy for the firm. He also serves as a member of GIC's Investment Management Committee and Currency Risk Management Group. Prior to GIC, he was with the IMF, where he was a member of the World Economic Outlook team and participated in missions to Turkey, the UK, Norway, and Cyprus. He published in peer-reviewed journals such as the European Economic Review, the Journal of International Monetary and Finance, and the BE Journal of Macroeconomics. He has also written several book chapters, including in the NBER conference volumes and the IMF's World Economic Outlook. Last but not least, we call onto the stage Mr. Taymor Baig. Mr. Taymor Baig is head of global economics as well as macro strategy for interest rate, credit, and currency at DBS Group Research. He also advises the bank on risk management and investment strategy. Prior to joining GBS, Dr. Baig was a principal economist at the Economic Policy Group of the MAS. Earlier, he spent 9 years at Deutsche Bank's Singapore office, where his last position was Managing Director and Chief Economist, Asia. Dr. Baig has published extensively for both specialists and a general audience on areas including monetary policy, digital currency, financial technology, climate change, demographics, frontier markets, fiscal policy efficacy, and financial market contagion. He's the host of Copy Time, a widely followed podcast series on markets and economics. So, distinguished panelists, thank you for being here with us today. So in this panel, being the first of the day, we aim to provide the audience with a helicopter view of the subjects of interest before we dive into the more focused industry-specific issues in the subsequent panels. We have 4 speakers that will be discussing the global and regional economic and financial backdrop, as well as trends in Indonesia's financial services industry. And we also have Bapak Gita Wiryawan providing us with a preview of what's to come in subsequent sessions. Gita will kindly furnish us with his insights about investing in digital ecosystems and green energy. Afterwards, we will have a brief Q&A session exclusively for Bapak Gita, as he will have to log off from the conference shortly afterwards. And then thereon, we can carry on with the macro theme discussion on economics and financial markets. First and foremost, allow me to hand the floor to our first speaker, Bapak Reza Yamura Siregar, who, as the host of this conference, will be explaining the structure and objectives of the conference. Pak Reza, the floor is yours, sir. We have 20 minutes, and allow me to give a quick signal to you 3 minutes before our time is up. Please go ahead.
Terima kasih, Pak Helmi. Thank you very much. Excellency Pak Erlangga Hartarto, Coordinating Minister for Economic Affairs, who joined us to taping. Ibu Sri Mulyani, Minister of Finance. Pak Kartika Wirjoatmojo, Vice Minister, State-owned Enterprises, Republic of Indonesia. Pak Fauzi Iksan, and Member of the Board of Commissioner of Indonesia Financial Group. Pak Robertus Bilitea, and the Member of Board of Director of Indonesia Financial Group. Distinguished guests, ladies and gentlemen. Good morning. Assalamualaikum warahmatullahi wabarakatuh. Allow me, on behalf of the conference organizer, to thank you all for being with us and taking the time this morning to discuss this first international conference carried out by the IFG with the theme of Insurance and Pension Fund transitioning into digital and green ecosystem. My job has been a lot easier with the previous keynote speeches, because they pretty much give us all the homeworks that I thought I was supposed to remind you all. So instead of going to a lot of those things in detail, what I'm hoping here is just to simplify the process and giving you a bit of how we design this conference and what is the rationale behind some of the sessions that we have today and tomorrow. Let me start with this is a slide that I borrowed from Pak Tiko. Pak Tiko explained the underdeveloping of our non-bank financial institutions. This is critical because, again, if we go back into the many experience of many countries around the world, and studies have been done a lot on this one, development of financial sector and the stage of financial sector development are critical as far as in terms of the prediction or in terms of predictor for the future growth of the economy and the outcome of the growth outlook of the economy. And as Pak Erlangga mentioned this morning, one of the milestones that we are actually aspiring to have is actually to become developed economy status in the next 2 decades, in which Indonesia is trying to aim per capita income at around 22,000 US dollar per capita, and clearly this is not an easy task. Many of the challenges that we face in terms of the low financial market must be addressed. Just to give you perspective, if we compare to any countries that is having a 22,000 or 25,000 per capita above around the world at this point, their financial asset, the asset of their financial sector is roughly about 350 to 400% of GDP. Now our number is of 2020 is less than 120% of GDP. So if we were to achieve or to help finance that industrial economic status within 2 decades, our financial market has at least to triple from what we are right now, or maybe even more. That's one lesson that we learned from the experience of the advanced economy. The second lesson is that when we look at the structure of the financial market, it has to be balanced. It cannot be based on the banking sector alone. It has to be also based on the non-bank financial institution as well. So this is something that also lessons that we learn from the development of other countries. If we don't have the non-bank financial institutions, then usually the development of the economy is going to be unstable. We will be going through many events of financial turbulence or crisis. So that's one thing that we learn. And this is something that what we hope to achieve in the discussions throughout the conference. That's the rationality. How do we design then the conference in order to address those a target of helping and finding or discussing ways to improve our financial market or financial sector? Sorry, let me just move this. Okay. One thing that we know from, again, countries' experience, financial market and macroeconomy, global and domestic, are linked. We cannot discuss or we cannot assess the situations of financial market of any institution or any economy without understanding the condition of the macroeconomy, without understanding the global economic conditions. And I will show you some of that evidence. We have gone through many cycles of crisis where the shocks coming from the global financial market, whether it's commodity shocks, what we see in 2008, transpire into our financial market in the system. And then the link between that macro financial, which is two-way links, macro affecting financial market affecting macro, is being amplified recently by the digitalizations of the economy and also by the transitioning to the green economy. So not only we have these linkages, the integrations that we learned, that we understood for many years of looking into this relationship, but the link between them, the link between macro and financial are amplified by the presence of digitalization and the green economy. Now let me give you some evidence of that. This is just a simple illustration of how, in the case of insurance, the premium are heavily sensitive to the performance of the economy. So like banking, capital market, insurance and pension fund are also macro dependent. And you can see here the performance of the economy is directly linked into the outcome of the premium of the insurance company. Same thing also if you look at the right-hand side, or at least in front of me, the right-hand side exhibit, we can see that the loss ratio of the insurance, or the general insurance in this case, is also functions of the economy. When the economy is doing well, we have the loss ratio, which is basically the total claim plus expense over the premium, is actually quite stable and quite low. But as soon as the economy is actually facing difficulties, we can see that the loss ratio is rising. So this is why I thought that the first part of our sessions is to understand the global, the macroeconomic outlook of the of our financial market as well, because again, there's closely linked to the insurance. Now, another evidence that I noticed also, this is from our study at IFG Progress, is that the cross-border flows that we receive, this is data from the balance of payment of Indonesia, where we can see that other investment flow, which is basically cross-border banking flows, are quite closely correlated with the credit insurance penetration. So when we see a lot of massive capital flows, especially post 2008 global financial crisis, you have a lot of QE in the developed economy, that has resulted in a pickup in the penetrations of the insurance, especially on the credit insurance of our economy. So again, another evidence of how macroeconomy, global financial sector are linked to our insurance performance. So this is also again why the motivations of the first sessions of today is basically looking at the macro outlook of our, the global financial outlook and macro outlook of our economy. We also have evidence that insurance and banking sector are closely linked. Again, linking again the story of macro to the banking and banking to the insurance. And also this is an underlying the issue is that unless we have a strong NBFI, it is very difficult for us to have a stable and sound banking system. If you look at the chart on the left-hand side, again, I'm facing the chart, you can see that it's quite interesting. For the case of Indonesia, credit insurance amounted to almost 16% of the total general insurance businesses. This is out of the chart if we go across many countries' experience. Typically, in many countries' experience is auto and property. For us, auto, property, yes, but also the banking credit. So credit insurance is big. Now, if you look at the right-hand side variables, again, during the pickup of loan at risk at the banking system, we have seen the credit insurance claim also picked up. So basically, our insurance sector is taking the risk of the banking system. Right? So again, this is why I'm looking at that micro-financial linkages. Within the financial linkages, also looking at the link between banking and insurance in order for us to be able to understand the ecosystem that we have in market expansion are going to be helpful, are going to be helped by the digital transformations. But at the same time, it also complicates some of that linkage that we mentioned before. For instance, are we going to push for some of that infrastructure that is required for digitalization to take place? We have in different parts of the world, if I'm not mistaken, over 60 countries now, have adopted localizations of data policy, which that data for the financial market has to be localized. Now the question is that, are we going to invest first on that database or data center capacity and keeping our financial market development on hold because we are not having enough data capacity localization before we actually allow the the financial market to develop? So again, there's a trade-off here. Another trade-off that we're also looking at, again, borrowing from the idea of impossible trinity, right? Can a country, for instance, adopt a free flow of cross-border data, cross-border informations on the population and benefit from that data monetization, where we are actually looking at quite happening a lot in recent period, while at the same time keeping data privacy and data security. So the debate again is also quite sensitive right now. Should we allow cross-border data flows and at the same time able to monetize the data while keeping database safety and privacy safety nets? So again, this is something that we are also looking at for this. Hopefully this is something that we can discuss in the next sessions when we look at digital and green economy transformations. Financing to transition to green economy is also part of the second sessions of today. Again, why this is critical? We've been talking a lot about technological transformations to support the green economy transition, but we never talk about the financing of it, or hardly talk about the financing of it. As Pak Erlangga mentioned, 60% of our energy is still non-renewable energy base. We are about the top 10 most polluter country in the world. About 2% of carbon emission is coming from our economy, right? So the question is that, how do we going to finance those transitions? What is considered to be green assets? So again, issue of financing, issue of what is considered to be the green asset is a big issue as well. Because if we are, again, at this point, only about 2% of our global bond outstanding can be considered as a green bonds. So it's still very small. So that's the first day of our conference. We'll be talking pretty much on the ecosystem of the global and macroeconomic conditions and the digitalizations and the green economy. Now, the second day we'll be moving into the industry. So we are starting with the pension fund. Again, Pak Tiko has highlighted the potential of our pension fund. Pak Airlangga also has mentioned that less than 20% of our labor force have access to pension fund, right? And again, we also, so it's less than 20 million of labor out of 130 million of labor force actually have access. And if you look at the penetrations and the number is also very low. At this point, less than 5% of pension fund, less than 5% of GDP is the size of pension fund asset. Now we play around with some scenario at IFG Progress. If we assume, let's say, a higher contribution rate, the level of contribution rate that we have seen in average Asian economy, and also higher rate of coverage, so the number of labor force actually involved in the pension fund, by the average of Asia, we can increase our pension fund from less than 5% by just increasing that coverage and rate into roughly 9 to 10%. So we can double. If we just look at the Asia standard, adopting their coverage and contributions rate, we can double. If we go by OECD standard, we can almost increase our penetration by 5 to 6-fold. So if we are involving the standard of OECD, we can increase our pension fund from less than 5% of GDP to about 30% of GDP. So this is a big source of funding for our economic growth and also for obviously sustaining our soon-to-be aging populations. Now on the insurance also we face the same thing. I didn't need to go to every detail of this presentation because it has been described well by Pak Tiko, but just to give you a number, Indonesia spent less than $17 on insurance per year in 2020, compared to Singapore over 1,100, and even Thailand is actually spending about $140 per capita per year in 2020. So the size of the penetration of insurance is still very small. And there's many of issues that was highlighted again also by Pak Tiko and the previous speaker, coming from even as much as just the human resource, the management of asset liability management, limited product development, and also the high cost of brokerage and agency. So this is something that hopefully we can discuss on the session of number 2 of the second days. I'm also happy to have the final sessions of our conference will be what we call a special sessions, where Pak Hexa and the team will be looking at some of the critical aspect of restructuring restructuring of our insurance firms. In particular, we are looking at basically what are the experience of other countries, what are the lessons learned, what are the key success of those restructurings, and what are the basically the low point of those restructurings. And it is important to have a successful restructuring in order for us to have a consumer protections. So this is something that we hope to be discussing also on the final sessions of tomorrow. Now, one of the things that we learned, at least from our study at IFG, asset matters. is quite interesting. When we classified our, let me just move into the on the next slide on this one. When we classified our insurance by asset size, so if we borrow the style of banking classification, book 1, book 2, all the way to book 4, we realized that the more, the insurance with a higher asset or high asset, above 25 trillion, is actually doing quite well. But those insurance that basically having less than 10 trillion asset size, they're actually having difficulty during the COVID period. You can see from the risk-based capital number that was again, this is the summary up to 2020 for the 39 life insurance policy, firms that we have. Now let me end this, my outline of the conference by highlighting the most fundamental problems that we face is basically on the issue of literacy. Again, when I'm talking about literacy here, I'm talking about layers of literacy at the level of public, at the level of industry, and also at the level of authority or the policymakers in general. We can see here there's a big gap between the non-bank and the banking literacy. What is even more concerning is that, to me, if you look at the capital market, you look at the pension and looking at the insurance, less than 20% of the population that was surveyed by the OJK have the strong literacy on those areas. And what is even concerning, if you look at the capital market, the number is only 5%. Now, this is very difficult to see how insurance and pension can develop when the understanding on capital market is also very, very low. Because again, the investment strategy and many of that development will depend on understanding of that investment products. So let me close my presentation by saying again, many thanks for the support and for participating on this conference. I look forward to productive discussions, and again, this conference hopefully will be the beginning of events that will be taking place at the IFG and IFG Progress. We will also have a smaller webinar series in this area where we focus basically on insurance and pension fund. With that, again, thank you very much. Wassalamualaikum warahmatullahi wabarakatuh.
Thank you, Pak Reza, and very perfect timing, Pak. You laid the ground very well for the forthcoming sessions, and I think you also presented very interesting statistics on the Indonesian insurance and pension industries. We'll have questions for you, but let's hold our thoughts and first hand the floor to our second speaker, Bapak Gita Wirjawan, who will be sharing with us his perspectives on investing in digital ecosystems and green energy. Bapak Gita, the floor is yours, and we have 20 minutes. Thank you.
Thank you, Pa Helmi, and thank you, Pa Reza. I want to take this opportunity to thank IFG for inviting me to be here alongside distinguished fellow panelists. Let me try to put in context what I'm about to lay out of what has been alluded to aptly by the keynote speakers, inclusive of Pa Erlangga, Bu Sri Mulyani, and also the comments that would have been made by Pak Tiko, and Pa Reza. Building this conversation or discussion in the context of what Indonesia wants to be at in the next 20 years, i.e. a modern nation, to be earning at a $20,000 on a per capita per year basis, and as to attain the necessary digital literacy, and as to attain, a wholly diversified competence landscape within the insurance industry. I do believe that these are tough ask, but very realistic ask. But let me just start out with a note of optimism on the basis that, as much as we've had great difficulties in the last 2 years throughout COVID, we've had only 0.08% casualties or fatalities in the context of the global population. And if you peel the onion a little bit more in the context of the Southeast Asian population, only 0.05% of the ASEAN population had died in the last 2.5 years due to COVID. This gives all of us a lot of optimism by way of comparing the statistics with what we might have gone through in the early 20th century at the Spanish flu outbreak, where 2.5 to 3% of the global population died, much less the Black Death in the 14th century, the year 1346, when 25 to 30% of the global population would have died. So on the basis of all this, I do believe that we have optimism to move on as a community. Now, I've prepared some slides. I'm not sure if the committee has it, but if we could move on to page 5, it is an illustration of how the global order has shifted. We have seen the global order moving in a very bipolar manner from the end of the World War II in 1945 throughout very much the end of Cold War 1.0 at around 1989 to 1992. And it was succeeded by a world that was very unipolar. And this kind of unipolarity was what actually brought about multilateralism in a big way, by way of the dominance of the United States that was able to basically encourage as many countries as possible to join in a multilateral framework, be it for economic or non-economic matters. However, ever since a few years ago, the global order has shifted from unipolarity to a multipolarity. And this has, I think, heightened the risk factors. And when we talk about risks, we always talk about how we're going to have to reprice risks. And I think we're likely to see more and more volatilities going forward. And I'm hopeful that it be in the short term as opposed to midterm and long term. The second observation that I think could complicate life going forward is the paradox of the democratization of information versus the democratization of ideas. We have seen a burgeoning number of channels through which information can be disseminated. However, we've seen an increasingly polarized world whereby people would only embrace what's on the left or what's on the right at the expense of the center, if not centrality. The third observation is really the paradox of the democratization of talent, where we have seen many democracies or liberal democracies around the world embracing more the selection of talent based on patronage as opposed to merit. Whereas an autocracy like China, I think, has proven itself to be a place where they've been able to select talent a lot more based on merit as opposed to patronage. The third observation with regards to the global order is the multipolarity and polarization of conversations. And this, I think, would have been attributable to how bad or negative narratives would have been amplified by way of algorithmic capabilities in the digital world. And this has complicated life, and even to the extent where it has been much more difficult to multilateralize. Productivity isn't everything, but it could be in the long run. And I think it's important for us to maintain center and centrality as for us to be able to move up the needle in terms of our productivity. The last bit in terms of the global order that we're seeing and we're likely to see moving forward, there's really 3 common threads that are going to bind us together. The first is the narrative or conversation on climate change. Where we end up with respect to how we would have committed to the Paris Accord, we don't know. I'm a bigger believer of technology as opposed to policy in terms of our ability to basically reduce carbon emission by 50% by 2030, 25% in 2040, and the remaining 25% by 2050. The second common thread is really public health that's going to bind humanity together, whereas the third is really what we've been talking about the last few hours, i.e. global finance. These are some of the illustrations that I think are likely to further color the global order going forward, at least in the short run. Now, moving on to page 6, which really illustrates some of the attributes that are going to color the post-COVID era. There are many here, but I think one notable attribute would be the slowing or deceleration of economic growth. We are already conversing about stagflation, if not recession, in some parts of the world by way of what's happening in Ukraine, but also by way of the disruptions on the supply side of the economy that have been affecting global economies in a much more adverse manner than expected. The second would be the higher degree of indebtedness. Well, I call this the financialization, be it the fiscal space or the space of corporations or the space of individuals. The third would be the digitization. I think we have come to believe that a lot of people that have been able to survive and adapt in the last 2.5 years are those that would have been able to basically digitize or virtualize. Unfortunately, those that were not able to show open-mindedness, they were not able to basically adapt, if not digitize, as a result of which they've basically gone through a bit of a slippage, business-wise or economically. The fourth is really what I call the super cycle of low inflation. I'm in a camp that believes that whatever inflationary pressure we're seeing at the moment is more transitory than necessary. I look at how the velocity of money is actually declining in the last 2 to 3 quarters, and I look at how demand has actually not peaked to a level higher than what it would have been on a pre-COVID basis. Of course, there are geopolitical disruptions that could further complicate things, that could affect, the yield curve going forward. But I'm sort of in a camp that believes that inflation is likely to be low in the long run by way of the amount of money that's going to pile up because of demographics. People are getting older, savings will go up, and the investment with that liquidity will only be in the same number of asset classes that would have been there for the longest time. Perhaps there's going to be an addition of 1 or 2 additional asset classes, be it crypto or NFTs or whatever, but I do believe that the exponential increase of money supply is going to entail a low interest rate environment and also a low inflationary environment. And this is also on the back of how productivity is being pushed up by way of the empowerment of artificial intelligence, the empowerment of digitization that basically has collapsed cost structures in a big way. The last would be what I call the decoupling between the US and China. This has happened in the last few years, and this will continue to happen. And I think people will inevitably have to choose which side of the game they want to be at. I hope Southeast Asia is not a place that will have to choose either between the United States and or China. Now, moving on to the mega trends of the world, this is on page 7. We are seeing certain mega trends that have changed our lives and lifestyles. The first one would be the abundance of capital and energy. Energy in the form of solar energy, which basically amounts to 8,000 times the amount that we consume, the amount of sun or solar energy that arrives. It all depends on the extent to which we can actually deploy technology so that we can have better effectiveness and better efficiency as to capture, as to store, and also as to transmit. The second megatrend is how money is being democratized. The application of blockchain as to democratize how money has been created, how money has been distributed, has been life-changing and game-changing. And this is manifested in the burgeoning nature of the crypto world in the last few years. And also artificial intelligence, which we've all been aware of in the last few years, and biological intelligence, which has actually been able to alter physical attributes of people, the intelligence of people, and basically a combination of biological intelligence and artificial intelligence would be manifested in what people have been calling as singularity. Now, these disruptions are key in basically shaping where the equity market is going to go. If we basically move on to page 9, just some illustration of how the value propositions of AI, energy storage, blockchain, robotics, and genomics will be. On page 9, we're basically looking at a delta of more than $200 trillion worth of market capitalization that will take place in the next 10 to 20 years. This is massive, and this is going to involve, I think, a lot of repricing in the industry sector, in the insurance industry, and it's going to, I think, be very, very exciting in terms of the financial services that we're going to be seeing not only in the world, but more particularly in Indonesia. Moving on to page 11, this is an illustration of productivity. Page 11 basically indicates Indonesia still lacks many other countries in Southeast Asia. We're still at about $24,000 in terms of marginal productivity on a purchasing power parity basis, as compared to Singapore at about 160 to 170,000. I do believe that digitization is going to play a big role in terms of moving the needle up from 24,000, hopefully to above $100,000 on a per capita per year basis. On pages 13 and 14, these are illustrations of how much carbon we've emitted. We've emitted more than 1,500 gigatons of carbon, and we're emitting about 60 to 70 gigatons of carbon on a yearly basis. At the rate that the world only has about 2 to 3,000 gigatons of carbon left, humanity basically has about 50 to 60 years left until and unless we come up with new technological innovations as to be able to move into the directions of renewables. And I think this is going to be key in terms of what we will be seeing in the next 5 to 10 years as to whether or not, number one, we're going to be able to emit a lot less carbon than 60 to 70 gigatons on a per year basis, but also to be able to achieve carbon neutrality by 2050. And if we take a look at the statement earlier made by Erlangga in terms of becoming a modern nation, becoming a developed nation in 20 years as to attain a GDP per capita of about $20,000, I want to put that in the context of our energy generation capability. If we move on to page 14, please, Panitia, we've got about 72,000 megawatts worth of power generation capabilities. We've got about 1,000 kilowatt hour of electrification on a per capita per year basis. In order for us to be a modern nation, we've got to be electrified at least at 5,000 kilowatt hour per capita, which means that we need to generate about 300,000 to 400,000 megawatts worth of power generation in Delta. At the rate that we're only generating a delta of about 3,500 megawatts of power generation capabilities a year, it's going to take us at least 130 years to become a modern nation. So there needs to be some realism in terms of what we aspire or what we have to be doing in terms of the delta in power generation capabilities. I do believe we've got to be at a point where we can actually create an additional power generation capability of about 10 to 20,000 megawatts a year in order for us to be a modern nation, as to be electrified at about 5,000 kilowatt hour per capita. On pages 18, this is an indication of Tesla, which is the electric car company, which trades at about almost $1 million on a per car produced basis, as compared to the Fiats and the Volkswagens of the world, which trade at a lot less than $30,000 to $40,000 on a per car produced basis. This is basically a manifestation of robotics, autonomy, and artificial intelligence. This is the future of the automotive industry that's going to be basically a lot more autonomous, that's going to be a lot more electric, that's basically going to help us save energy or carbon emission in a much bigger way. And if we go to page 19, these are some of the opportunities that we can reap in Indonesia. I think we can see healthcare, education, energy, agriculture, but I think the point to highlight is really the financial services. which only represents about 40% of the GDP, the delta or the upside potential is huge. A typical modern economy trades at about 100 to 150% of its GDP in terms of its financial services. So there's still a lot of upside for Indonesia to go up from 40% to 100%. That gives you a pump of, around 650 to 700 billion dollars on a yearly basis, and that gives you the kind of picture of where the financial services industry is going to go by way of how and what we can do with the digitization. However, there's a structural impediment here in terms of the money supply. If we take a look at the money supply to GDP ratio in Indonesia, it stands at about only 45%. So whatever you do in terms of the financial services, it's going to be structurally limited by how much you can create in terms of money supply. The typical modern economy has a money supply to GDP ratio at about 150 to 250%, inclusive of the United States, the EU, Japan, China, and the UK. So I think this is a homework for us in Indonesia, is to be able to figure out how to increase M2 to GDP ratio from 45% to at least 100%, so that we can see a much more robust delta in terms of the improvement with respect to the financial services industry. Ending this conversation, I just want to point out that we are seeing at least, if not more than $100 trillion worth of money supply floating around all the developed economies. At the rate that interest rate is going to be hiked by at least 100 basis points, there is going to be at least $1 trillion worth of additional liquidity that's going to be created just by the hike in the treasury yield that we're seeing and they're going to be seeing, in the next few months. In conclusion, how do we get by so far, and how are we going to get by going forward? There's three attributes that are going to be needed, and this is reflected on page 20. The first is agility. This requires the leadership of a company, the leadership of a nation, the leadership of anything to basically be open-minded. And I think open-mindedness has been witnessed by way of how a lot of people in Indonesia have been able to adapt by way of digitizing. Unfortunately, there's still quite a lot of them that were not able to basically make the necessary adjustment by way of digitizing. The second is the speed, and this relates to what Patiko was alluding to earlier in terms of the competence that we have to recruit, not only within the insurance industry, but we have to basically make sure that we're surrounded by people of merit, people of competence, people that can actually speed up feedback loop within an organization and also within a country. Last is really the humility that's going to be required for and by a leader or the leadership of a company or a country, where the guy at the top or the girl at the top needs to be a lot more focused on the main course as opposed to the appetizers and desserts. The main course being defined by what's going to be out there in the long run. Thank you very much.
Thank you, Pak Gita, for the very insightful presentation. Okay, so let's now move on to a brief Q&A session focused solely for Bapak Gita. We'll be inviting participants to ask questions, but allow me to start and get the ball rolling. So, Pak Gita, we've seen that throughout the pandemic, tech company valuations globally have been pushed up by tailwinds from, I think, at least two fronts. First is the movement of many aspects of our lives from offline to online, whether it's work from home or simply ordering foods from our phones. And the second is the ultra-low global interest rate environment, as huge stimulus packages were dispersed by central banks around the world. This year, however, we're already seeing that life is already partly returning back to pre-COVID. Meanwhile, global interest rates are set to rise significantly, possibly for a protracted period in order to combat inflation pressures. And along with that, we're already seeing many tech companies, valuations are falling and finding it harder to obtain funding. So how big of a risk do you think these headwinds are to the continuity of investments into the digital and green economy ecosystems?
Thank you, Helmi. We've seen major countries' central banks doing quantitative easing amounting to more than $10 trillion just in the last 2.5 years, inclusive of the United States, the UK, the EU, Japan, and to some extent China. And I think this massive infusion of liquidity by way of the QE exercises would have been a major reason why we've seen valuations spike up until recently. And by way of what we're witnessing in terms of supply side disruptions, by way of COVID, zero COVID policies in China, by way of what we're seeing in the Ukraine situation, I do foresee, a situation where I think the tightening that's being done by the major central banks, at least, lingering on for quite a while. During which time, I think it's going to be a lot more imperative or important for tech companies to show the two notable attributes, right? Path to profitability and how they can actually keep on improving in terms of cost management / innovation. Unfortunately, we're seeing some of the victims as of late in many countries around the world that have not been able to show those attributes, i.e. the path to profitability, and number two, basically how they could actually expand upon the ability to manage cost or even expand upon their innovative capabilities. I think what we'll be seeing in the next year, if not two, is sort of like a further curation or filtering of who's going to be able to survive. And we saw a bit of this in the early 2000s by way of the tech boom or bust in 2000. And we saw a bit of this in the 70s by way of the inflationary pressure that we saw on a much more sustained basis. But I would argue that the inflationary pressure at the moment is not likely to be what we might have seen in the 70s in terms of how it's going to be as sustained as what we might have seen in the 70s. Because at that time, relatively speaking, I think the government, particularly that in the United States, decided to basically just massively, supply money into the equation in a much bigger way and a longer period of time as opposed to what we might be seeing.
Thank you, Pak Gita. So let's now open up the Q&A for the floor. Let's start with members of the audience. Please feel free to raise your hand and we'll have a mic delivered to your table. Or alternatively, we can, is there any questions from our online audience? If not, okay, so let's wrap it up here as Bapak Gita has to leave us soon. It's already late there in the US. Bapak Gita, thank you for sparing the time to share your insights with us. It's much appreciated. Please stay healthy and let's give a big applause for Bapak Gita.
Thank you. Thank you.
Okay, so distinguished participants, we have 3 more bright panelists that will enlighten our view on the global and regional economic and financial backdrop, as well as what it means for portfolio asset allocation. So let's move on to our next speaker, Mr. Prakash Kannan, who will not just be giving us his take on the structural changes to the global economy in coming years, but also explain to us what these global developments mean for portfolio asset allocation. Mr. Prakash, the floor is yours and we have 20 minutes.
Hello. Terima kasih and selamat pagi. So I was actually born and raised in Malaysia, so I can attempt to do this whole thing in Bahasa, but maybe for your own benefit, I think I will stick to English. I'm actually going to stand up because it's a bit difficult for me to see my screen. And if you can have the slides up. Yeah, thanks. So I'm going to talk a little bit about asset allocation, and I think afterwards one of my panelists here, Taymor, I think will put a little bit of that into the global macro context. But I thought that with the insurance and pension fund managers here, I think it's very important that we are really, I think, in my view, entering a very different macro environment, and I think that has quite profound implications for asset allocation. I'll try and keep my remarks brief. I know you've been listening to a lot of people talking. Let me see if this works. We can go to the next slide. Yeah. So basically, I'll just be making 3 points today. So the first point, as I was saying, is that we're really moving, I think, to a very different growth inflation regime. And that, I think, will be very painful for a balanced portfolio, right? So a balanced portfolio here is, let's say something that has about 60% equities, 40% bonds. I think that is an environment, that's a portfolio which I think will actually struggle in the transition that we're experiencing. And then just in terms of thinking about what we can do about it, I think some of these issues that we've talked about already, so diversification, thinking about real assets, and then I'll talk a bit about alpha, because I think this part of this issue of climate change, I think could actually be seen as an opportunity. And I think really as an opportunity to kind of beat the benchmarks and also to generate better returns. So let me talk about the first point. So this chart here basically shows our forecasts for GDP and inflation for 3 main country groupings, right? So the first one at the top right is for emerging markets. The one on the bottom left is developed markets, and then the one in the middle just shows the overall global forecast. So what you have on the y-axis here is, the y-axis is inflation, and the x-axis is GDP. And I'm showing here the shift that we made in our forecast going from Q4 of last year to Q1 of this year. And mind you, these are 3-year forecasts, right? So they're actually trying to smooth over a lot of developments in the near term. And as you can see, what we have done here is that we've moved a lot of our forecasts in a very kind of negative direction, right? So we are seeing that the global growth momentum is likely to shift to something that's lower. And at the same time, we've actually increased our inflation forecast. And I'll show you in a bit why, from an asset allocator's perspective, this shift is actually one that is moving in general in a negative direction. Now, part of this challenge, I think, is also that when you look at the emerging market space, I would argue that actually the emerging market space has actually experienced a big slowdown in growth. And that slowdown actually has reduced the so-called premium that you have had of emerging market growth over developed market growth. So this blue line over here I show you is how much emerging markets have grown relative to developed markets. And you can see that since the global financial crisis, that gap has reduced quite significantly. Now, if we take out China and we take out India, actually the gap with developed market almost goes to 0. And you can see that period right around the time of 2016, all the way to pre-COVID, that gap between emerging markets and developed markets was close to flat. Now, central to the story of emerging markets is really about China. And here I show basically a little bit more from a longer term perspective. I think what we all realize, which is that the trend growth in China is coming down. On the left-hand side, you can see actually the growth rates in China for partitioned by decades. So we have experienced in the past growth rates of China that was close to 10%. But if we look at just the last decade, 2010 to 2019, that has already fallen to about 7.5%. Now, when we think about the next decade, so this chart on the right-hand side comes from work done by Bert Hoffman. So he here is trying to look at Chinese growth from the year 2021 to 2035. And you can see that in the baseline scenario, that growth is going to come down to something about 4.5%. Our own internal forecasts also actually have trend growth in China coming down to 4% by the end of this year, and then actually even going to about 3.5% for the next decade. So when we think about growth, yes, this outlook looks challenging now, but in general, the pace of trend growth we think is likely to go lower. And likewise, when you think about inflation, so what I'm showing here is basically the distribution of inflation over different decades for the US. Right? So you see those little circles that I've drawn there. That shows the most the kind of modal outcome for inflation over the different decades. So if you go back all the way to 1980s, we actually did not see a rolling 3-year period of inflation that was less than 3.5%. If we forward to where we are today, if we look back at the last 10 years, the most likely or the most experienced inflation we've had was just in the order of 1 to 2%. We have actually never had a 3-year period of inflation that went higher than 3%. But we're all experiencing it now. And as I go back to that chart that I showed earlier, we are likely to experience it for the next 3 years. So putting these two things together, we can see that actually the environment for growth is likely to be more challenged going forward. But then for inflation, it's likely to be higher. And I think one challenge with this mix is that at the same time that we are getting this kind of lower growth and higher inflation environment, is that policy is going to be tightening. I think as the previous speaker was saying, we have not only short-term interest rates going up, but also the balance sheet policies of major central banks are likely to turn in the opposite direction and actually start shrinking. One thing that worries me a little bit, and perhaps in a little bit contrast to the previous speaker, is that I think we are likely to see inflation persisting at a higher level for longer. And that first chart that you see all the way on the left-hand side, that was a survey done by Morgan Stanley. And the question that they asked for is, if you're doing any supply chain changes, why are you doing the supply chain changes? And you can see that more than 50% of the respondents said that they were doing it for business continuity as opposed to cost competitiveness. And this is a big change from where we were, I would say, pre-COVID. Where pre-COVID, this whole idea of thinking about globalization was about reducing costs. But now there is an element of resiliency, there's an element of business continuity, and which puts actually cost management, which is of course still important, but a little bit as a secondary concern. So therefore, I think when we think about inflationary pressures going forward, along with some other notions of deglobalization, and then the pressures as well on the state to actually keep funding some of these climate transition initiatives, I would argue that actually I think the persistence of inflation is likely to be with us for a lot longer. So if you put these things together, what do we see as the outlook for a traditional balanced portfolio? So here I show the performance of a portfolio which is 65% in equities and 35% in bonds, going all the way back to 1960. And you'll see two periods which were almost 10 years long, where these portfolios have given us almost 0% real return, right? So the first one, as you can see, happened during the 1970s, and that was a period of stagflation, so very high inflation but low growth. And then the second one was following the bust from the dot-com boom, right? So just after 2000, you saw a long period where asset valuations fell, particularly in the US, and then that was also exacerbated by the global financial crisis. And so once again, you had a period of 0% real return. So if we think about where we are today, this is a chart I've taken from Research Affiliates. It's actually up on their website. It's a good place if you want to go to get at least what they think of as their capital market assumptions. And what this chart shows is basically their estimate of future returns for a broad range of asset classes. And here the horizon that they're thinking about is 10 years. So what you have on the x-axis is a measure of risk, which here is just basically a volatility. And then on the y-axis is the expected returns, but in real terms. And if you look at the balanced portfolio, which is this thing that I've circled right in the middle here, so here it's a 60-40 mix. At least as far as they are concerned, they think that for the next 10 years, a balanced portfolio only gives you slightly less than 1% real returns. So if I remember one of the earlier speakers here, you know how, especially for some of the insurance industries where there was a promise of, let's say, 7%, 8% payout ratios, it's just looking to be very difficult, kind of given where your starting conditions are today. And the biggest part of that challenge, if you look on the left-hand side, is really fixed income, right? So fixed income here, given today's starting yields, as most of you in the business know, that a very good approximation of future returns for fixed income is basically just today's starting interest rate. If you look at where we are starting today, that 10-year horizon outlook for fixed income would barely give you a positive real returns. Now, it's not all bleak. I have highlighted two areas on the top right where I think actually there is a lot of promise. The one that's on the furthest top right is actually equity markets outside of the US. And I would count actually Asia as one of them. Obviously, you're taking on more risk, and for some insurance and pension fund providers, it may be difficult from a mandate perspective. But I think that's where the opportunity is. It does involve a little bit more risk, as I mentioned. And then the second one is actually real assets, right? So the real assets dots here are both real estate as well as infrastructure. And here again, going back to this theme of climate change, I do think that one of the ways to kind of think about climate change is actually not only from a defensive perspective, which is where you're concerned about stranded assets, etc., but actually also from a perspective of opportunities. And I think here a lot of the opportunities in providing transition financing, but also in investing in new technologies, everything from carbon capture type of technologies all the way to actually renewables. I think that's where there is a lot of potential. So what are the ways out of this? So as I mentioned, I think there are three things. The first one I think is diversification. And diversification I think is important because I think as much as the global growth picture and inflation mix, as I mentioned, does not look very promising, there are pockets of very strong growth potential. And I would actually put Asia and actually particularly Indonesia in one of those categories for which I think there's actually a very strong potential to kind of punch above its weight relative to that outlook for the rest of the world. Second is I think the shift to real assets. I do think that in that environment where inflation risk does become more evident, it's likely that financial assets will be more hit. But then you have real assets, especially things that are indexed to inflation. I think that is where you can actually preserve a lot more of your capital. And then finally, on this idea of alpha, I think if we think of beta as being some mixture of just equities and bonds as a core part of your portfolio, I think that in this environment, that core part are actually going to be very challenged. So we really have to think a bit outside the box. And so I think this is where, once again, the opportunities in the climate space, opportunities in technology, and on this dimension, I agree very much with what the speaker spoke about just now, and actually also opportunities in Asia, where I think, as I mentioned, I think that the growth dynamics, I think, are much better relative to what we see in some other parts of the world. So let me stop here, and always happy to take questions later on. Thanks.
Thank you, Mr. Prakash. A very insightful presentation. I'm aware that you have a flight to catch very soon, but let's see if we have time to slip in a short Q&A session before your departure. One takeaway that I noted from your presentation is that in the years ahead, global asset returns probably will not benefit as much from across the board returns as in the past. So that's the emphasis on alpha. And against this backdrop, the expected real returns are higher in the equities asset class, including EM equities. However, it occurred to me that a possible issue that a global asset manager might face is that energy transition targets in EM economies tend to be less ambitious compared to those in DM economies. So we may not have a broad-based set of investable counters in the EM equity asset class. So my question is, how should fund managers find the optimal balance between seeking returns and generating alpha on one hand into the EM equity asset class, and on the other hand, being ESG compliant?
No, thank you. This is a very very important question. In GIC and actually even myself, I think we believe that assets or companies that are sustainable and that practice good governance will ultimately yield high returns, right? So if we think about some kind of trade-off between sustainability and good performance, I think that trade-off is less stark than it used to be. And I believe that as more and more investors behave this way, that actually it will both be moving in the same direction. So what I mean is that companies who are currently in the call it traditional energy sources, but most importantly, don't have any plans to transition to not 100% renewables, but at least in that direction, I think those companies will naturally be penalized in the financial market space. So in that sense, I think it's important to think about the dimensions of like good investment returns and good sustainable practices. So obviously everyone wants to be in that corner where you have good sustainable practices and good investment outlook. But I think more and more companies will naturally be shifting to that space. But where we are focusing a lot of our energies on are actually companies which have good investment outlooks, but currently are not in a good sustainable zone, whether it's power generating companies or even companies which have kind of different practices. And I think what's important is actually that we help them in the transition to getting to better corporate governance, a better kind of sustainability practices. Because I think in emerging markets, it is that to me is very important, because it doesn't make sense to just, let's say, shut down a coal generating power plant, because that entails job losses, it impacts families, it impacts livelihoods. So you're not getting the S criteria of ESG. So I think we really, as investors, we really have to be, I think, actually work a lot harder, because we have to be partners. We have to help these companies make the transition. And I think in emerging markets, that becomes much more important.
Thank you, Mr. Prakash. Okay, so we don't want to make you miss your departure flight. So thank you very much for flying over here to be with us and sharing your insights. Let's give a big round of applause for Mr. Prakash.
Yeah, so sorry I have to run, but it's been a pleasure. Thank you very much.
Thank you. You may leave the stage. Okay, so next we move on to Mr. Ranjit Singh, who's with us via video conference. Mr. Ranjit, we're very much looking forward to hear your views on the outlook for the global financial sector, as well as the global policy environment. And without further ado, the floor is yours, and we have 20 minutes. Thank you.
Thank you. Can you hear me clearly?
Yes, sir.
Very good. Well, first of all, good day to everybody. Thank you very much for helping me for moderating this session. Let me begin, first of all, by thanking the Indonesia Financial Group for their very kind invitation for me to speak at this impressive international conference. I'd like to commend Pak Reza for putting together what is definitely looking like an excellent program, and I'm honored to be speaking with such distinguished panelists. Before I proceed, let me caveat by saying that the views that I express at the forum today are my personal views and don't necessarily represent the views of the IMF. And now, when Pak Reza spoke to me, he asked me to share some of the main findings of the IMF's April Global Financial Stability Report, which is the team which I oversee. And therefore, my presentation today will cover a few of the charts that we have used in the GFSR, but please feel free to go to the IMF website and look at the full Global Financial Stability Report for more details, if you like. And I think Pak Reza also wanted me to cover a bit more on the US and the advanced market angles. So I'll attempt to put some of those points across in the presentation. This particular report, of course, as with any other financial stability report that have been written out, have been challenging ones. I spoke a few days ago, last week, on the launch of the ECB's Financial Stability Review, and it was quite clear that there were quite a few common themes that were appearing in terms of how we looked at it. Clearly, when we began drafting the report early on, the main focus was about inflation and how central banks would react. Emerging market central banks were front-loading rate hikes. Some advanced economy central banks also had begun doing so. But of course, the entire report had to be completely shelved once the Russia-Ukraine war broke out, and we had to rewrite it with no obvious template that we could use. So when we looked at the financial conditions and the vulnerabilities associated with the effects, the transmission channels were not that clear, and for this kind of shock. But what was apparent was that one of the most obvious ones was around commodity markets, and so you see that theme very strongly prevailing in the report. And we thought of that within two angles. One was the macro view and how this would make the problem faced by central banks in advanced economies and emerging markets much more complicated in terms of the trade-offs. You've heard speakers talk about, much less growth, higher and more persistent inflation. But we also looked at it in terms of financing and the disruptions in commodity markets for financing for banks, collateralized lending, and particularly for derivatives markets, and how the concentrated positions from the angle of dealer banks as well as energy trading firms complicated the analysis. And of course, you saw the issues pertaining to interconnectedness with the London Metal Exchange, which was an example. But the report also goes on to look at other exposures, including asset management exposures. We also looked at cryptization and touched on some medium-term issues, like those associated with energy security, and again, reinforcing some of the messages that Gita was making around the importance of climate change and the broader points being made around sustainability that we had. But we also touched on other factors around implications for risk fragmentation in payment systems, cyber risk, etc. So there's a whole bunch of things that were covered in the context of medium-term implications in the report. Let me briefly share some of these points, and I'm not sure whether somebody is sort of clicking my slides, but if they are, could I move on to the next slide, please? Right. Okay. Thank you. So if you look at that particular slide, essentially it puts forward the kind of complicated trade-offs that are currently apparent within what is continuing elements of uncertain geopolitics. And there are several key takeaways that appeared from the Global Financial Stability Report. First of all, clearly financial stability risks have increased, and the balance of risk to growth have tilted to the downside. Inflationary pressures have increased across the board, leading to the need for decisive monetary policy action, and inflation remains, of course, the first order concern, which in turn implies a complicated trade-off for central banks. And I'll talk a little bit more about this in the slides after this. And what was also clear, it comes out of the report, is there is a risk of differentiation within emerging markets, particularly those among those who are commodity importers and commodity exporters. But the higher risks of capital outflows in emerging markets and developing economies is certainly becoming a concern. And the high debt in emerging markets has been noted, and the risk of a pullback of capital flows could occur with a generalized risk of sentiment in emerging markets, which people have begun to worry about. And further exacerbating the overall conditions, as we all know, are the financial vulnerabilities which remain elevated in China, and the report continues, provides a focus in the property sector, but the overall growth slowdown in China is certainly playing on the outlook for markets. And then, of course, as I mentioned, there are several medium-term challenges, including what has now become a more difficult issue around the challenge between energy security and climate transition, with energy security concerns impacting climate transition risk, and which can have ramifications in the short term. And so let me elaborate on some of these points. Let me move on to the next slide, please. Once we look at the next slide, what this shows, these slides show, is that there is as you can see, a significant tightening of global financial conditions. If you look at the left slide, you will see essentially our financial conditions index, and it shows that there has been a meaningful tightening of financial conditions. The decline in corporate valuations, the higher bond yields, and of course the expectations of monetary policy tightening amid rising inflation has resulted in a notable tightening in both advanced and developing economies since the start of the year. However, relative to historical levels, the advanced economy financial conditions overall remain roughly neutral, and the impact has been greater for many emerging markets, especially for those that were closer to the conflict. You can see the sharp rise in Central and Southern Europe in the chart on the left, which in this case does not include Russia or Ukraine. The US and Euro area have had some tightening, but still loose by historical standards. And amid this uncertainty, there are significant downside risks to the outlook, as shown in the right-hand chart. Our growth at risk model, which links financial conditions to the distribution of future GDP growth outcomes, clearly shows that the balance of risk to growth this year remains skewed to the downside. Let me move on to the next slide now. When you look at the next slide, this is looking at slide 3, the one before this actually, right. So when you look at this particular slide, this shows you the impact on risk assets. And again, a point that has been mentioned by previous speakers. And if you look at risk assets have clearly experienced heightened volatility, with investors basically oscillating between optimism and fears. And as you can see, after initial deterioration risk assets, there was some recouping in the global equities. And when you look at the middle chart, you can see amid the high uncertainty about the monetary policy tightening path and fears of a recession scenario looming, equity markets sold off dramatically, particularly in the US, and until the performance late last week, many of the indices were already showing that we were into a bear market territory or very close to it. But there was certainly some pullback in the markets towards the later part of last week. And if you look at the chart on the far right, that shows you that global credit spreads have widened, surpassing pre-pandemic levels across major sectors. But you can see that the increase has been most evident for some of the lowest rated firms and riskiest countries. And if you could now move on to the next slide, please. When you look at this particular slide, this really shows that essentially inflation pressures have continued to build up across the board. Again, advanced economy nominal bond yields had already been rising, and this move had accelerated after the invasion. And while the move has reflected an increase in growth break-evens and real rates, the rise in inflation pricing following the sudden increase in commodity prices has really been the primary driver, particularly in Europe and the UK. If you look at the middle chart shows in the US, the yield curve flattened substantially, and it breaks down the year-to-date changes in the advanced economy yields. And you can see that inflation break-evens have risen sharply, especially the 5-year horizon. And whilst these inflation expectations on the long term remain mostly well anchored, we did see some pressure over the recent period. And of course, the chart on the right shows you emerging markets. And of course, for emerging markets, risks have increased amid the higher food prices, and inflation has continued to surprise on the upside, in several cases remaining above target, as you can see quite clearly from the chart. So an incredible rise in yields that we've seen since the beginning of the year, and the combination of pessimistic future growth and future inflation concerns, the stagflation scenario that was alluded to is beginning to prevail in a lot of the sentiments out there. When you turn to the next slide, this again very clearly shows that the rise in inflation has significantly shifted higher the expected path of monetary tightening and brought forward really the anticipated hiking cycles. As you can see, what is priced in markets is much tighter than what was priced earlier. And the so-called forward path for monetary policy are much higher everywhere really in the world. So you see it clearly for the US, the ECB, and in the emerging market regions. And of course, the US Fed delivered 50 basis point hike at the May meeting, and markets are pricing almost 8 hikes for the year. The ECB As indicated, interest rate increases could follow the end of the asset purchases, mentioning recently that the current outlook allows for interest rate hikes to move out of negative territory by the second half of the year. And of course, markets are already starting to price in additional hikes very soon. And you've seen commentary appearing from the ECB in this regard. And within emerging markets, while many emerging markets had front-loaded hikes and responded decisively to the inflation pressures before the war, there still is an expectation of more to come. And certainly for EM Asia, this has been an exception, but you're beginning to see a pickup occurring more recently. If you move to the next slide, we see very clearly in this slide that yeah, correct, that's the right slide. Yes, so when you look at this particular slide, you really see that I suppose in many cases, what central banks are trying to argue is that there is going to be this soft landing. And however, the normalization of central banks' balance sheet may present some additional challenges. Clear communication is going to be crucial to avoid unnecessary market volatility. On the left chart, our models that estimate that quantitative easing had led to approximately a 50-60 basis point reduction in the term premium, and when looked at railways, and therefore a rapid unwind and move to quantitative tightening risks a sudden decompression of this term premium. And so the Fed really is left in a difficult spot to manage a soft landing while also battling this high inflation. And this chart that on the right-hand side shows the effective Fed funds rate along with the spread between the 10-year and 3-month yields. And it shows that the recession periods are shaded. And during periods of high inflation, the Fed funds line is colored red. Historically, an inverted 10-year, 3-month spread, which is shown in purple, has been a consistent predictor of an upcoming recession as markets price in eventual easing by the central bank. And so while the Fed has managed soft landings in the past, it has been many years since it needed to raise rates while dealing with such inflation dynamics. And so in many ways, at the moment, there is no version. But if growth expectations, if the short rates go up to 30%, and what happens to the 10-year is something that's going to be looked at very closely. And if the spread does invert sometime, and then the scenario changes very easily. Of course, our baseline is that it will be a soft landing, but clearly there are lots of downside risks around that forecast. I know I'm running short of time, so let me push on. If we could move to the next slide. Look, I'm going to skip this slide and the next couple of slides. Let me go straight to one after that, one more. If you could do the next slide, please, one more. Right, okay, let me talk about, just to make sure that I've addressed Reza's mandate to me to speak about both the US and the Euro area. If you look at the Euro area, I think, again, I wanted to highlight this because it is also a point that was picked up by the ECB's Financial Stability Review last week. Clearly, the ECB is facing a complicated trade-off, bringing back inflation to target while containing fragmentation risk. As you can see, the spreads on the left, chart on the left shows that spreads have widened since we published the Global Financial Stability Report, and fragmentation risks have begun to remain much more in focus. And however, you will see that while still low by historical standards, Southern European country spreads have widened. And since the ECB announced its intention to scale back asset purchases, and the move has been exacerbated more recently. And against this backdrop, therefore, with fiscal deficits and debt levels remaining relatively high in some countries, as the right chart shows, with borrowing needs remaining large, the risk of further tightening of financial conditions looks very, very apparent. And as I said, the ECB in their financial stability review last week also warns that financial fragmentation could emerge with spreads higher for higher debt countries compared to low debt countries, as debt sustainability deteriorates more rapidly for these firms and governments in these countries. So clearly, that is a scenario that is of concern moving forward. If we move on to the next slide, this really, I'm sorry, the one previously before that. So, yeah,
Mr. Ranjit, just to remind you that we have 1 minute left. Thank you.
Thank you very much. So I'll skip this particular slide in that case. Maybe I will go to the one after that. And in this particular slide, sorry, can you move on, please? Yeah, well, this actually really talks very much about emerging market differentiation and looks at the risks in the context of emerging markets. Once again, one concern that we have here is the rapid increase in the spreads with a high number of issuers which are at risk. And our capital flows at risk model clearly shows that the likelihood of tighter financial conditions in a normalization developing economies is likely to increase downside risk for EM portfolios. Perhaps in the interest of time, I'm going to skip the next slide on China and go straight down to the slide on crypto, which I'm going to skip as well, and finish off with the policy challenges at the end, which I think was in the presentation slides. Do we have that? And the final slide, please. One more after this. Let's go on. Slide after that. Yeah. All right. So essentially, these are some of the policy challenge recommendations that were made in the report. The need for central banks to act decisively to prevent inflation from becoming entrenched. Clearly, policy normalization in emerging markets should continue based on country-specific assessments, and regulators should assess the implications, the elevated volatility in commodity markets and market functioning, risk management. This is highlighted particularly in the context of some of the issues we saw in commodity markets. And as I said, the challenge for commodity energy transition, climate transition, whilst managing energy security is going to be first order and top of mind. So let me end there. Thank you very much, everybody.
Thank you very much, Mr. Ranjit, for the very insightful presentation. I've also been just informed that you also have to leave for another engagement. So before we move on to Mr. Taymor, perhaps I could ask a question to you, sir. So a major trend that we've been seeing and will probably continue to see across industries is the building up of redundant capacities done under several contexts. In the context of COVID, for example, we've seen companies building redundant supply chains to manage the risk from lockdowns. And then there's also the context of green energy, where companies build green energy sources in order to retire fossil fuel sources. And another context that's emerging is we'll probably see companies in Europe potentially building redundant capacity in order to diversify their energy away from Russia. So how do you see this trend of building redundancies affecting the financial system, where funds that are needed to build these redundancies are tapped from? Do you see this as a long-term risk for the financial system? As I would imagine that the IRR of these redundant investments is probably not that high. Curious on what your thoughts are on that, sir. Thank you.
Yeah, well, thank you very much, Pahelmi. I think, clearly, I think the point is probably most significantly reflected in the context of the climate transition, and as you mentioned in the question as well, I think, when you look at the issues, I think this is going to be one of the key challenges that begins to appear. And again, this is what we've highlighted as a more medium-term structural issue, where to be able to create to reach the targets for net zero emissions that has been put forward, the estimated investments that are required for renewable energy generation is going to be significant. And in that context, I think one of the key things which needs to be done is to see how the mobilization of transition finance can be addressed. Clearly, with the cost of capital now going the wrong way, this is going to be a huge challenge for transition finance. And so to look at the transition finance side, I think, you need to, one of the things that we've emphasized is the importance of the climate information architecture. Clearly, to be able to address that, to create, you need to be able to make sure that, you address some of the issues around disclosure, data, climate finance taxonomies. This is work that needs to be done in terms of creating the preconditions for mobilization of climate finance. Clearly, you've seen growth in the ESG domain, and some amount of financing that occurred. But it's also very important for there to be work done in addressing concerns around greenwashing. So ultimately, it really is to create the preconditions around transition finance, really, for addressing some of these renewable energy and shift that you alluded to. So those are some of the factors that we think are going to be an important factor.
Thank you, Mr. Ranjit, for the very comprehensive reply. Okay, so we don't want to hold you up any longer, so a big round of applause for Mr. Ranjit. Mr. Ranjit, thank you very much for sharing your insights here today.
Thank you. Thank you very much.
Good night. Okay, so let's move on to Mr. Taymor Baig, who will share with us the outlook for the region closer to home, which is Asia. So Mr. Taymor, please I hand the floor to you, and we have 20 minutes.
Thank you very much. So I'll do what Prakash did. I'll also stand on the side and get this presentation on full screen mode. Few thoughts. Firstly, and this has been echoed by speakers earlier, but I think we need to be very clear. There will be no blinking by the Fed this year. There will be no relenting with the large interest rate increases that are being planned and priced by the market. You would have to have very big shocks to growth or something big in the financial sector to happen for the Fed to relent. So even if growth indicators in the US start to soften, they're not going to stop. I was discussing the Fed outlook with UC Berkeley's Barry Eichengreen on Thursday, and he made a very simple point, which is that from the Fed officials' perspective, 0 or 0.5 real neutral rate is what they're trying to get at, and nobody in the Fed can forecast anything less than 4% inflation next year. So if you think that in the next 18-month horizon, inflation is not going to come under 4%, and your view of the real neutral rate is 0 or 0.5, I guess we can all add, right? 4 plus 0 is 4, and 4 plus 0.5 is 4.5, meaning even the reasonable Fed officials are probably going to be forced to vote for interest rate increases going all the way up to 4 to 4.5. Now, that's not our forecast. That's not what the market is thinking. But if inflation doesn't come down anytime soon, that's the kind of scenario that we might have to deal with, which is not being priced by the market at all. So the Fed is determined to deal with the demand side inflation, and all that question that most of the inflation is supply side and war related and COVID related. What can the Fed do? Through the interest rate channel, they can work on the housing side, they can work on expectations, they can raise the cost of financing for cars. There is a lot that the Fed can do, even if a lot of the inflation is coming from the supply side. So let's be ready. This is not ending anytime soon. Secondly, and I think in Ranjit Singh's presentation that came up a little bit, so we need to think a little more about this issue, that as interest rates go up, and we haven't seen interest rates go up like this in a very long time, what kind of accidents are we going to see happen? Whatever has happened in the tech stock space, in the slowing down of capital raising, there are no accidents. They're okay so far. We haven't seen any major slip-ups like the way we saw during the Lehman crisis, or we saw with the Mexican tequila crisis in the mid-90s, where as the Fed raises interest rates, you have major defaults, major crisis, spillover and contagion around the world. That's to come. That hasn't happened yet. So we got to keep in mind what's happening in the tech industry, whether it's just the 20, 30, 40% stock price correction that we have seen is just the tip of the iceberg, that we could see much bigger things in the coming months, or overall fundraising, whether it is SPACs or IPOs, what happens there. And then there's the whole issue of sovereigns debt in the emerging markets in particular, where we are actually seeing crisis beginning to break out. So Sri Lanka basically in default, Pakistan very close to getting toward default. We have major stress in Lebanon and Turkey, and of course the usual candidates like Venezuela and perhaps even South Africa. So among the economies in the world with large debt, needing massive international financing, there is a lot of stress that is building up, and we will probably see that happen. I do still believe that the risk of an outright recession is much less than a risk of outright meltdown in the financial markets. Of course, financial market stress spills over into the real economy. But I still think that, especially when we think about the households in the US, where net debt is close to zero, when we think about the corporate sector balance sheets around the world, where debt has gone up, but overall fundamentals are still pretty good, duration is manageable, interest rate costs are manageable, I think the risk of corporate sector malaise spilling into the real economy in a very big way, the way we saw, say, in the '97 Asian financial crisis, I think is somewhat less this time. But on the financial sector side, there's a lot to worry about, even though banking is not the big part to worry about, but non-bank financial sector, markets, lots to worry about. Then there's this issue of China. And I think, this is something that we all have noticed in the last 6 months. We have always thought of China as a very pragmatic economy. The policymakers are pragmatic. When things are difficult, they are not ideological. They will do what is right for the country, what is right for the markets, and they will do whatever is necessary. But if you think about what the Chinese have been telling us over the last 3-4 months, is that don't worry, the tech regulation behind us. The property market tightening should be easier going forward. More money is coming for banks, more money is coming for the overall economy, don't worry. And in the past, that was enough. Whenever they said they're going to do the right thing, we believed them, and we put money in the Chinese stock market, we put money in Chinese bonds, and things worked out. This time, it's not working out like that. The authorities want the economy to turn around. They want us to believe that there is no more crackdown on Tencent and Alibaba. They want us to believe that the property market meltdown is behind us. But the market is not buying it. So the traction that the Chinese had on policy is somehow a bit weaker. And that worries me a lot, because I think that upends 20, 30 years of paradigm, which is every time there's a downturn, the Chinese sort of know what to do and they'll figure things out. So we don't need to worry too much about economic slowdown in China. The system corrects itself. I don't think we're buying the system's capability of correcting this time. But I'm not going to only talk about bad stuff. I think sitting here in Southeast Asia, while we are worried about inflation, we're worried about what's happening in the rest of the world, we should be also taking solace in the fact that we do have some offsets. And I'll go into greater detail later, but I think the three things: what's happening with exports, what is going to happen with tourism, and our ability to deal with COVID, I think are three things that we should keep in mind as possible mitigants. Now, I think we saw something like this in Ranjit's presentation. So we need to start thinking about not all the stuff that has bothered us over the last 12 to 18 months, which is inflation, going through the roof and the central banks being behind the curve. I think it is time we start thinking about whether all that worry is beginning to peak. If you look at the fixed income market, 5x5 inflation expectations, they're not relentlessly going up anymore. They're beginning to flatten out. In fact, they're a little lower than what they were maybe 3 or 4 weeks ago. So the market is seeing what's happening to food, is seeing what's happening to fuel, but is also seeing what the central banks are doing, and they believe that there is sufficient credibility in the policy efficacy of the major central banks. So we don't need to start projecting 3, 4, 5% inflation going forward. So the US, very much anchored around 2, 2.5, Eurozone about 2, which is a lot higher than it used to be, but it's not going nuts. And the UK is a bit of a special case where inflation expectations are a bit higher than what we see elsewhere. Well, that's the inflation story. What about the growth story? Well, on the economic surprise side, of course, we've had a few negative surprises lately, and that's bad news, and that's certainly feeding into expectations of this stagflation and fear, which is high inflation and low growth. But we should also consider the other option, which is low growth and low inflation. You heard a few speakers earlier talk about how they think that medium-term inflation could be persistently high, but also we heard from Geeta, who believes that there are long-term drivers of inflation that'll start keeping it at bay. So whether we believe a regime shift in high inflation, or whether believe that the long-term forces are actually negative for inflation, we don't know which way things are going to pan out, but the fact of the matter is the central banks still have credibility, and low growth has a way of bringing down inflation risks. Classic example is China. If China is going to slow down substantially in the coming years, you can be sure the world of commodities will not have a secular uptrend, because China is the biggest buyer of all the big commodities in the world. So if China is slowing from 5 to 4 to 3 in the medium term, whether it is fossil fuel, from oil to coal to gas, or it's metals, it will be difficult for the markets to rally if the biggest source of demand in the world, which is China, is slowing on a structural basis. Similarly, with respect to Fed expectation, the last 6 to 9 months, we've been ratcheting up our expectations. In 2022, they'll hike by 100 basis points. In 2022, they'll hike by 150. Then we're like 200 basis points. I think we have gone far enough. Now it's about, well, maybe there is a limit of how much the economy can take. So when you look at the market pricing, it's flattened out. We're not getting shocked by the new inflation numbers. We're not getting shocked by all the stuff that is coming out news-wise from Ukraine or the problem of global supply chain. We're saying, yeah, about 250 basis points, maybe a little more this year, cumulative, that's about it. And the market is now beginning to price in virtually no rate hikes next year, meaning whatever the Fed can do, they'll do this year, and that's it, no more. Same with dollar. The US dollar has risen relentlessly in the last few months, and that's put a lot of pressure on regional currencies, including the rupiah, but we're probably reaching peak dollar as well. So this is an interesting time to have this macro discussion, whether it is inflation expectations or growth or Fed policy expectation or the US dollar. In all of those major sources of global market volatility, we may have reached the panic part, and now we're going to consolidate and we'll sort of stop relentlessly pricing these things higher and higher. Okay, we talked a little bit about China, and I think this is an important thing to keep in mind. Although China is the biggest source of demand in the world, the US matters more for Asia than China. And this holds up in regression analysis for every single country in Asia. With the slight exception maybe of Indonesia, where it doesn't really matter either. Indonesia has its own growth dynamic. But for the rest of the world, Asia, the red line being China and the blue line being US, this is a 17-year-old growth regression that we have done. The coefficient of the US is always much, much bigger than the coefficient of China. What does it mean? It means that we are part of this supply chain where what China buys from us is very important, but China is not really buying it for its own consumption. It's buying it for the rest of the world's consumption. So that big supply chain and a lot of the regional, intra-regional trade that we're seeing, it's for the rest of the world's demand. And if the rest of the world is slowing, we have a problem. If the rest of the world is doing well, we'll do well. But putting it all together, it's not really about China. It's about the rest of the world. So the offsets that I was talking about earlier, that we will worry about China's slowdown, but we will focus on what's happening in the US, especially on the export side. We'll also think about what's happening on tourism, which was basically non-existent in most of 2020 and all of 2021. but that's coming back. That's good news for Asia. And also this point that I made earlier, that our ability to live with COVID, think how horrible things were 1 year ago, and think how normal things are right now. So we're not gonna slip like the Chinese have. We're gonna move forward. All right, so on these 3 points. First, exports. Exports are softening, but it would have softened anyway, because a year ago, we were growing by 30, 40%, big base effect from 2020, right? So on the back of that 30, 40% increase, we are at about 10% growth right now. Indonesia, Malaysia, Thailand, Vietnam, etc. That's not bad at all. We are doing pretty well considering all the headwinds that exist around us. Our exporters are doing pretty well. PMI, as a result, in the region hasn't collapsed like the way it has in China, or it isn't showing the kind of nervousness we have seen in the US. Regional PMIs are holding up, regional exports are holding up. Why? Well, semiconductor demand, not as strong as the massive spike that we were seeing last year, but still decent, not that bad. We have heard some negative guidance from US chip companies that the demand is not what it used to be, but as far as Asian exports are concerned, things are holding up, not that bad. Supply chain, lot of negative talk, but shouldn't we also say that given the sort of disruption we had in the last 2 years, we actually managed to pull through. We talk about deglobalization forces and how we are focusing on resiliency as opposed to cost competitiveness, all that. But let's also take our hat off to all our suppliers and all our shippers that despite having all the difficulties, we really did get our stuff. When we ordered an iPad, when we made an order on Amazon, we did get those things. It was a bit late, few weeks here and there, but things came through. When you looked at that, great slowdown in shipping in the West Coast ports in the US last year, they have eased up substantially. So supply chain is not just stuck in this COVID-related disruption. It's working its way through, it's helping us, and it's helping Asian exports. Then, of course, the Fed cycle is a very big factor. If demand is strong, rates will keep going up, and then the exports will suffer. But again, considering all the stuff that has already happened, exports are not bad, and that makes me a bit confident about Asia's outlook for this year. Second issue is tourism. Of course, the Chinese tourists are not coming, and the Russian tourists are not coming. These two groups were very large sources of resiliency for regional tourism. So if you look at a country like Thailand, between 2015 and 2019, the black line being China, China became a much bigger player in their tourism sector. Philippines, same story. These are basically gone for the time being. But what are we talking about? We're talking about 2021 when there was no tourism whatsoever. So the base is basically zero. So therefore 2022, in all of ASEAN, tourism will be a very large source of growth, even if the Chinese don't come, even if the Russians don't come, because we're starting from zero. So for the hotel owners in Bali and Phuket, it's still going to be a good year because last year was the absolute worst year ever. It has to be better than that. And then finally, COVID. So this chart is the number of total cases in many countries in Asia, and the vertical axis is the last 5 days new cases. And the nice thing to see in this chart is that every single country, with the exception of China, is a teardrop, meaning we have had a lot of cases, but now it's just collapsing like a rock. We have been vaccinated, we have boosters, we have antivirals, so even if we get COVID, no big deal, but also chances of us getting COVID is also lower because we're all vaccinated. So as COVID becomes another really bad flu, which requires serious attention, but at the same time does not cause our schools to shut down, our airports to shut down, our factories to shut down, we will move on, and we are moving on. I mean, the fact that I'm here in Indonesia for the first time in 3 years tells me that we are moving on from COVID. So tourism, big plus, living with COVID, a very big plus, still resilient exports, another plus. So yes, worry about the war, worry about all the other things that are happening in the world with respect to supply chain and Fed hike and capital flow volatility, but let's also take comfort in the fact that 2022, despite all those negatives, will be a pretty decent year for Asia, particularly ASEAN, all challenges notwithstanding. Our exporters, our hotel operators, and our healthcare workers will help us go forward. That's all I have to say for now. Thank you.
Thank you very much, Mr. Taymor. So, very insightful presentation. We've reached the Q&A session. So we'll be opening up questions to the floor, but probably I'll start with a few to get the ball rolling. And perhaps I'll first address a question to Pak Reza. In your presentation, from your presentation, I saw at least a number of factors that run opposite to each other with regard to the growing size of the growth in the size of the insurance and pension fund industries in Indonesia. So on one hand, post-COVID, we've seen a substantial increase in the number of people now having access to financial services, right, through the disbursement of these subsidies, through these various cards. But on the other hand, COVID has also led to a shrinkage in the size of Indonesia's formal labor force, formal sector labor force. And we've seen the informal sector post-COVID has grown significantly higher. So I was just wondering, how do you think Indonesia should deal with this challenge? And what kind of policies would we need to see in order for Indonesia to be able to continue increasing the penetration of the insurance and pension fund industries? Thank you, sir.
Thank you, Pak Helmi. I thought I was here supposed to be only just explaining how the conference work and not expecting the questions to be asked on me.
Surprise, Pak.
Yes, I think there are two issues, fundamentals to the questions that you asked. One is issue on stability, ensuring that what we face during the COVID and post-COVID has to be managed, and that the lasting impact will be minimized. I think that's one of the objectives, and that's always been the objective of the government so far. So managing the impact and the cost, and especially maintaining that the cost will not continue. This is not only through the financial system, but also obviously on the labor force of the real economy. So subsidies, all those, what we call the cushioning policy, through the fiscal expansion, fiscal stimulus, has been the core of the COVID episodes, and it continues this year. And hopefully that will be something that we are able to slowly move away from. But again, what we saw this morning, I think this is something that I would like to thank my colleague here, that the issue that we face as far as what happens globally, the issue of demand recovery that is expected, but at the same time, the fact that inflation has picked up strongly, that also indicating that there are more than just demand recovery taking place. There are issues, as we know, about the geopolitical issue lingering on the supply value chains. Those are the things that continue on the backdrop of our environment of the economic outlook. And this is something that we are going to be, I mean, again, the objective of these first sessions is basically to, again, remind all of us here, especially our colleague from the non-bank financial institutions, that when we think about the inflation, we think about the exchange rate volatility, we think about outlook of growth, that will have implication on our premium, our claims, and therefore also the overall performance of the insurance sector of the economy. Now, in terms of the policy, again, I think the reality is that we are slowly moving into more productive spending to boost the growth. And I think that will be also something more in line with some of the things that we are doing on the development of the financial system itself. the push that we are looking at this point, or at least from this conference, is basically how we can basically push non-bank financial institutions to support future growth. So I think we are looking into more toward that dimensions. But again, risk mitigations, the role of insurance to risk mitigate, the role of pension funds to provide some of the cushioning of the financial needs are just going to be even larger going forward. And I think this is something that we have seen. So, Pak Helmi, I think the bottom line is that the global economic outlook that we are seeing at this point, in my views, continues to be a challenge. Again, I share the optimistic of Taymor, but I think we are not completely out of the woods. And I think this is the role of the insurance and the further down the line, the issue of pension fund will be critical. Thank you.
Thank you, Pak Reza. Okay, so before we move on to asking questions from the floor, Mr. Taymor, excuse me for asking possibly an out-of-topic question, but it's still a relevant question, I think. So we've seen commodity prices plateauing, but remaining elevated, even though we're seeing global growth prospects being toned down as the US tightens and China also slows. So what outlook do you see for global commodity prices in 2022 and 2023? Do you think it'll slump back down to pre-2022 levels once we see a decline in geopolitical tensions, for example? Or do you see it remaining elevated as, for example, sanctions regimes against Russia remain or are even slightly tightened going forward? Thank you.
Sure, happy to talk about commodities, but before I go into commodities, I just want to make a point. It touches on what Reza said earlier and also what Prakash had said. You may have noticed that in Prakash's presentation, he began by making the point that emerging market growth is getting lower and lower, and the gap between EM, DM is narrowing. But at the end of this presentation, he suggested that from a portfolio allocation perspective, we should look at emerging markets as a source of high growth. Now, you may think that what he said at the beginning, emerging market growth is slowing, and what he said at the end, that emerging market stocks are attractive, are contradictory. They're not. There's a third element there which makes it important, which is valuation. Despite the recent sell-off, developed market assets are still wildly overvalued. The Case-Shiller price earnings ratio for S&P 500 still has the US stock market at over 30, a number that we haven't seen other than times of like the 1920s bubble and the pre-dot-com bubble time. So Asia may have some growth challenges, but at the same time, from a valuation perspective, Asian stocks are extremely attractive, and therefore for the medium term, they remain an important part of the portfolio. I just felt that I needed to add that point. Now, on commodities, which commodity are we talking about? Metals versus energy, very different dynamic, and within energy, very different dynamic. Starting with oil, there is plenty of oil in this world, including in current capacity. It is just a question of getting it out to the right people at the right time, and also depending on refining capacity. There is a global constraint on refining. That's a problem, and therefore once you start taking the Russian refiners out, there's a problem with respect to refining. But as far as crude production is concerned, between the Latin American countries and the US and the Middle East, you can completely ignore Russia, and there's still enough oil for all of us in the world. Not an issue, just a question of getting everybody to do their part and getting it transported around the world, which is why we're increasingly hearing the Europeans talking about sort of fast-tracking their ban on crude oil exports from Russia into European Union. Gas is a different story. It's very local. I'm sure there are some people here who are exposed to the natural gas industry in Indonesia. The US gas price is not the same as European gas price, and it's not the same as the gas that's coming from Qatar. So the LNG, LPG industry is a function of, right now, the production capacity of the Middle East, because the US is its own market, and Russia certainly has created major uncertainty as far as European gas market is concerned. So gas price, as far as Europe is concerned, I'm not seeing that coming down anytime soon. They are trying to import a lot from the US. They're trying to sign new deals with Qatar, but I think there is a short-term spike there. So I'm going to remain fairly constructive on gas as opposed to on oil, where I think peak numbers are around us. And let's also be very clear, when we talk about $100 oil right now, that is nothing compared to the real oil shocks we have seen. Because if you adjust for inflation, oil would have to be at 150, 160 to be comparable to what it was in the 1970s. And our energy intensity is lower today, and we're paying in real terms much, much less. So the oil prices capture a lot of headline, but they cannot affect our economic outlook the way they did in the 1970s. We rely less on oil, and in real terms, oil price is lower. Then there's coal. Coal is interesting because China and India have not given up on coal. The rest of the world, particularly in the West, coal is a very dirty word. Coal-driven power plants are being phased out. Companies that are in the coal industry are getting poor ESG points. They struggle to raise money in the green bond market, whereas in this part of the world, particularly because of the strategy that China and India are pursuing, I think for low sulfur coal in particular, there's still a market out there, ESG concerns notwithstanding. This is what I meant by within energy, there are lots of idiosyncratic factors, which energy, which part of the world you're talking about. But for the medium term, I do believe that you want fossil fuel prices to be high, not because of demand, but because of supply constraint and carbon tax. Because if you don't have fossil fuel prices high, energy transition doesn't make sense. If oil is $30 a gallon, and who cares about green energy and all that kind of stuff? It's so cheap. So for the transition to happen, we need the relative price adjustment. And if it is not happening from the demand side, it has to happen from the carbon tax, from regulation side, because only then solar and wind and green hydrogen will make sense from a cost perspective. Now metals, very different story. The irony of the green transition is a brown process. If we are going to support battery technology, we have to produce a lot of cobalt and copper and nickel and all the other rare earth materials, which from a mining perspective is not the best for the world, but we absolutely totally need it for the green transition to happen. So therein lies the fallacy or the irony that for green transition to happen, metals prices and metal demand would have to be very high. And therefore, all the countries that make these things are going to be making a lot of money. And of course, battery manufacturers are going to be doing very well. But once we go past industrial metals and start thinking about precious metals, I'm not particularly bullish. Look at what has happened to gold. We have had the biggest inflation scare in a generation, and gold has gone toward $1,800, $1,900 an ounce and kind of flattened out there. Why? From the hedge fund industry, from the asset management industry, gold is still seen as a speculative tool to play when inflation picks up. But that is not the main source of demand for gold. Gold demand is largely physical. Who buys gold? Indians, Chinese. The rest of the buys too, but the Indian and Chinese demand is the main driver of gold price in the world. And there, that physical demand for gold is very price sensitive. Indians and the Chinese are not going to buy gold at $2,200 an ounce. As it heads toward 2000, you see a massive correction in physical gold demand in these two parts of the world. So regardless of what the gold funds out there and Wall Street is thinking about as far as gold and its role as an inflation hedge, the biggest source of gold price determination comes from the festivals in India and the weddings in China, and those sources of demand very, very price sensitive. So which is why I don't necessarily see gold also playing a major role, and I'm not particularly bullish. Sorry, a long-winded answer, but commodities is complicated.
Yeah, thank you, sir, for a very comprehensive answer. I think you exceeded all our expectations. Okay, so maybe I'll open the floor to questions. We have one. We have time for one or two. Yeah, the lady on the middle table, please. Okay, and please introduce yourself before asking the question. Thank you.
Thank you, Pak Helmi. I'm Rizka Muslihan from Asabri. I'm interested in explanation from Pak Reza excuse me, can I off my mask? Yeah. About your slide about penetration and contribution, and also continuing from the explanation before. If I may raise the topic about, forgotten market. This is my exaggerating terminology, just to grab your attention. Forgotten market is about army and police market. In Asabri, we are managing only 1.3 million, which is only less than 5% of Indonesian worker, and less than 10% and less than 5% of populations. That's very small. And also I take a look at your table that the penetration and the contribution is very small, 0.2 and standstill. I don't know whether the policymaker or government pay attention to our critical market or not, but in fact, in my experience where I'm come to get closer to my customer, I really listen to their grievances. They are really find difficulties how they can secure their life and also pension fund. For example, like none of insurance company, either private or other company, can protect their pension because of they categorized like very high risk people like army, pilot, and so on. And when there's a private insurance company can cover, as we all aware about, the premium is really high compared to their income. That's really difficult for them. So in this opportunity, I'd like to share my thought in my really humble opinion to the government and policymaker. Please include them, consider them, the army and the police, as our asset of the country, as the critical market as well. How this country, how Indonesia, with this current financial environment, be able to secure and protect the army and police with the proper insurance, and I don't know about pension fund probably. So the welfare and also the protection for them can happen securely, Pak. Thank you.
Thank you. I think we still have 5 minutes left, so maybe one more question from the gentleman on the right-hand side table. Thank you.
Ibrahim Rahman from IFG Progress. My question is for Pak Taymor. Thank you very much for a very interesting presentation. I'm interested with one in your slide saying that the Chinese impact on Asian economy is very small. When we see from the beta coefficient, it seems like the impact of Chinese growth on Indonesia is very small, and even smaller for Vietnam, which for me quite surprising, given the fact that majority of our exports is for Chinese market, and I think for Vietnam is even more so. And if we look into the proportion of FDI, foreign direct investment as well, China is one of major contributors for Indonesia and Vietnam. So how can we rationalize the finding? Because it's quite counterintuitive if we see just from the slide. Thank you.
Okay, so maybe we take the second question first and the first question second. Thank you for your question. You know, this is the paradox of China's growth model, that China is almost like a processor. It's the factory of the world. So when we talk about demand from China, we're really talking about demand from the rest of the world. So the regional supply chain is such that stuff that goes from Taiwan into China is not necessarily for China's final demand consumption, but for Apple, manufacturing, and there the demand for that Chinese import is really a function of demand for US import. So China's central role in the globalized economy in some ways makes our trade relationship with China a function of the rest of the world as opposed to the domestic demand? Now, of course, the country has 1.4 billion people. So if we are making something that those 1.4 billion people would consume, of course, our demand would be very large, and China's ups and downs would reflect on our bottom line. But the fact of the matter is, most of the things that the Chinese people consume are made in China. Most of the things that the Chinese are importing are inputs for the rest of the world. Now, I'm not talking about commodities, I'm not talking about food, that is largely for Chinese own consumption. But when we talk about the regional supply chain, and when we talk about Asia's exports, so whether it's Vietnam or Malaysia or Thailand or Singapore, they are largely exporting as part of the supply chain as opposed to final demand. But you're absolutely right that going forward, that coefficient estimate of China in every single growth regression will be rising. It is not small. 0.3, 0.5, even today is a large number. It matters. What I was trying to say is that the US matters much more. So all the talk of decoupling and all the talk of China's emergence, you still have to take into account that the West's demand is still a very big component of our economic outlook because Southeast Asia has signed up also as part of the global supply chain. That's the only point I was making.
Thank you, Mr. Taymor. I think we're now running out of time. So, there's a second question. Okay.
Yeah, let me just quickly answer the questions from Ibu on the Asabri. I think again, let me share what we found, Ibu, with the study that we did at the IFG Progress. And again, we have not, to be honest with you, looking at in detail firm by firm levels, whether it's Asabri or BPJS, TK, and so on. But we try to look at the whole industry, and we try to basically gain some lessons from other countries' experience and see what matters for us in terms of dealing with some of the key questions that very valid from you. One thing that we at least noticed from, let me start with the pension itself. Contribution, whether it's defined benefit and defined contribution, is critical on the success of the pension that we notice. Many countries has shifted, Ibu, from defined benefit to defined contribution. It is not easy, but it's clearly that I think tomorrow you will hear a lot more on this. That by moving from defined contributions, we will have a lot more agile system and more reliable system going forward. And this is something that we learn from the experience of those countries. And then second issue is basically coverage. At this point, it's quite interesting. When we do a bit of review and survey and asking questions, what we notice in Indonesia at this stage, if employer, firm are looking for labor, and they put requirement as anyone working for them to be enlisted on a pension scheme, what we notice is that increasingly at this point, that type of firms is actually less attractive for the potential labor or potential employee. So they would not involve in any fund, or they would rather have, if they have a choice, they would rather go with firms without having the obligations to be enlisted on the pension itself. So coverage is another issue, Ibu. So one thing is that, again, as I said to you before, we just play around with the average Asia. If you look at the size of contribution and the size of coverage and move it into just the average Asia, we are able to move from anywhere less than 5% of GDP in terms of our total pension. I'm talking about BPJS, Asabri, and I think there's one more, to close to 11%. Almost or doubling if we just manage to do that. So that's the key lessons. Now, you mentioned again the key questions about sharing of the risk. I think that's the critical part of it as well, because what we notice also is that the insurance part is also critical in addressing some of this ability for us to provide aging population with their, or at least retirement with their pension. I think this is one of the things that we also noticed for the advanced country with the pension funds. They have also big support on the insurance side. So the insurance is actually supporting the pension. The ability of the pension to be able to provide their claims, I mean, to provide their liabilities eventually to the pension holder is actually with the support of the insurance. So some of the, like you say, in terms of claims over accidents, health claims, and so on, is associated with pension is actually partly covered or largely covered by the insurance side of the firms. So, and if I may take it a bit further, looking at the study that we're also looking at how to link that into digitalizations and the green economy, I think again we came to the conclusions that they're actually mutually inclusive. The move to the digital economy and the move into a green economy are actually necessary conditions for the insurance and the pension to develop. And the development of insurance and pensions are also necessary conditions for us to be able to finance digitalizations and green economy. Because the green economy transitions and digitalizations are long-term investment. And so that will be suitable for the type of investment that needed for us in the insurance side and also in the pension side. The size of capital needed are large for us to move into like Pak Erlangga say, just for the 2020-30 green economy transition, we need at least 25% of our GDP, I mean nominal GDP of 2020. That's a huge amount of money. We are looking at basically close to 250 billion US dollar. Right? So that has to be financed. And if we are not able to finance it domestically, how do we finance it domestically? It's through the pension fund. Again, with the support of the insurance. Otherwise, we are going to be depending heavily on foreign borrowings. So there's a lot of things going on here, and I look forward for the discussions tomorrow on this one, Ibu. But I think, again, those are some of the experience that we face, or at least what we learned from the study that we did across the different countries in the part of the world. Thank you.
Thank you, Pak Reza. As we're running out of time, so let's wrap it up here. And let's give a big applause to our distinguished panelists. We also thank all distinguished participants for being very engaging in the session. And with that, I'll hand the floor back to our MC. Thank you.
Thank you very much, Bapak Helmi Arman and all the speakers for this session full of remarkable insights. And we kindly ask you to stay on the stage for the presentation of a token of appreciation. We now kindly invite to come up to the stage President and Independent Commissioner of Indonesia Financial Group, Bapak Fauzi Iksan, to present mementos as a token of appreciation to our speakers and moderator. We would like to extend our sincere thanks to our esteemed speakers and moderator for sharing the valuable knowledge and insights regarding the global and regional financial environment.
As a reminder, this is our first session, and we will have a second session today and 3 more sessions tomorrow, including a special session, which is not to be missed.
May we kindly ask now Bapak Fauzi Iksan with all speakers and moderator to stand together for a photograph.
Once again, we thank all speakers and also moderator and also Pak Fauzi Ihsan. Let's give another round of applause.
Thank you very much. A round of applause, ladies and gentlemen.
Thank you very much, Pak Fauzi Ihsan, also all speakers and also the moderator, Mr. Helmi, for moderating our session today. Distinguished guests, Bapak dan Ibu yang terhormat, ladies and gentlemen, before we start the second session of IFG International Conference 2022, we will have a lunch break. Please enjoy the cuisine we have prepared for you, and we will see you again in our second session at 1:30 p.m. Jakarta time. For those who wish to conduct their afternoon prayers, you may find the prayer room near the entrance. Just head right from the entrance to find the mushola. We'll see you at 1:30 p.m. Thank you very much.